Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clement. Sam, say hello.
Hey, John. How are you doing?
Sam, I'm doing very well today. I hope that you are.
I'm doing great. I can't complain.
I'm glad to hear that because a lot of people might be able to complain because here we are, March 19th in the afternoon, and earlier this afternoon, the Federal Reserve announced that it did not cut the overnight lending target. And,
exhilarating.
Exhilarating. No one is really expecting the Fed to cut the overnight lending target rate. However, gee whiz, it sure would have been nice. Cheaper capital into the U.S. Economy and financial system might have been just the B12 shot that we needed. However, we didn't get it, and all we got was the Fed sitting around and saying, hey, we're going to cut our quantitative tightening down to, $5 billion a month?
Yep.
Which is essentially they've stopped it.
Well, I think you have people on both sides, and by both sides, I mean there's people saying, hey, we still need to hike rates. Inflation's not fully back down, and you have people that are saying we need to cut rates yesterday. And frankly, I think there's a lot of validity to both sides of it. I mean, I think you can make a good argument for either way, and also that we needed to do nothing right now.
Well,
and so that's a tough position to be in where I could probably be swayed with a good argument that we need to be doing either, and a lot of that depends on what is most important to you.
Well, there's a word for, I think, kind of what the Fed was talking about here today, and that's what happens when you have lower growth rates and higher rates of inflation.
That's stagflation.
It's called
but
stagflation.
I don't buy that. I don't buy it.
Which is not really the best term, the best word. People don't want to hear that. And I would tell you that, I talked about this, it's got to be kind of difficult being a voting member of the Fed because, let's face it, they're dealing with maybe imperfect data. Everyone thinks that they have some kind of special, crystal ball or some sort of special inside access to information, the way the world actually works, and they have some sort of just inherent ability to just be right about everything. And unfortunately, they're not any more right, if that's the correct way of saying it. They're not any better than really a lot of other people in trying to predict where the economy's going.
Well, these are all people with backgrounds in their field, but the data, they may get it a little before us, but they're not looking at a bunch of proprietary stuff that we are never going to see, And this is, economics is often called a social science because there's no, it's never fact what we're talking about. It's all theory, and you can't test most of this stuff and relationships between things. And so it is a guessing game. And we've talked about it, and we've seen it with, they say, hey, rates are going to be here at the end of the year. Well, you'd think you'd be good at that considering you're the one who sets that rate. And even then they're wrong. So if the person who sets the rate doesn't know what the rate is going to be, who in the world can know? And so it's just a tough thing to do to predict.
When you put it that way,
it's impossible to predict. And so again, I think it goes back to my point that it's really tough. It is not a concrete, you do this and this is going to happen. There's unintended consequences to everything, and social sciences are inherently difficult.
Well, I was kind of laughing about that because it is kind of comical. Sit there and say, I predict we're going to have 2 rate cuts this year. Well, because
I cut the rates.
I cut the rates, but I could be wrong.
Yeah.
I could be wrong in my assessment. And there's a lot of truth to that because in the dot plots here today that the Fed released and sort of median projections, all this, that, and the other thing, they have now cut their take on what gross domestic product will be for 2025. I think taking it from 2.1% down to 1.7%. Unemployment rate is expected to tick up to 4.4%, maybe. And then, but however, the overnight lending target is really only supposed to get down to 4%, I think, with the effective rate being 3.875 or thereabouts. So these are all just throwing numbers at it. And frankly, Sam, in a lot of ways, it feels like they're shooting spitballs because, some of the comments Powell said were taken to be a little bit dovish afterwards. He started speaking 1:30 Central Daylight Savings Time, taken to be a little bit dovish. However, some of his comments were like, in my estimation, we don't really know what's going on here either, guys. The hard data says one thing. It says that the economy is in pretty good shape, but the soft data is saying something else, and blah, blah, blah. And I'm beginning to believe that no one is completely at the helm of this, not even the Federal Reserve.
So what is it? Who's driving things.
Well, I mean, that's a whole deal. I guess you would have to say that the markets are. I mean, the markets themselves are driving, not the
Which the
financial.
Austrian economists would love that.
I mean, the markets themselves, not the stock market, but the markets themselves. But then also just, I mean, people are worried about what's going to happen with tariffs, what's going to happen with Doge, what's going to happen with all this other stuff. And that's what Chairman Powell's talking about in terms of the soft data, sentiment gauges and all that stuff falling through the floor, whereas the hard data, what's people are actually spending money on and what have you, that remains okay. However, at some point they're going to converge. At some point my perception might turn into reality, and then the Fed will have to act at that.
Well, and I think part of the difficulty is what we talked about recently with the divergence between the haves and have-nots, and how that skews. Again, they're looking at the same data we're looking at, and broadly some of the data looks fine, but when you break it down, it's not that the average, most are doing fine, it's that some are doing phenomenal and a lot are doing very poorly. And so how you manage that, I think, is also difficult. And, we talked about it this morning with the chicken and the egg, with the markets and the stock market and the labor market, and the relationship that those two have. And so does a bear market lead to labor market weakness, or does the labor market weakness lead to a bear market? And so you have all these things and variables and what's important and what's not. And, we've started to see it with some dissenters in some of these votes on either cutting rates or slowing the easing. They're not really as much in a consensus as they used to be.
They aren't, and that's okay in my estimation. Back when I got into the industry and Alan Greenspan was still in control, it was really sort of a one-man show. And it was what Alan Greenspan said. We all called him the maestro and all that stuff, and turns out he wasn't any better than anyone else. He just happened to be at the head of the Fed at a very unique time demographically for the U.S. economy, when the baby boomers were hitting their peak earnings years, and you had you had the silent generation, which was small. And so you just had more people working, more people making more money, and everyone said it was Alan Greenspan was the cause of it. And it's just demographic shifts in the U.S. economy. However, I go through all that to tell you that it was a one-man show back then, and I think they got it wrong a lot. However, it's not necessarily a one-man show right now, and I don't mind that because it does allow for new ideas and perhaps some conversation at the table, as opposed to one person just simply dictating things.
Which is important given the facts we just mentioned, that these are they're not working with perfect data and they're not perfect people. So with that, knowing nothing else, it's probably good to have a conversation about things.
Well, the thing is, I mean,
chairman's board.
Jay Powell can look at the labor market data just like I can, and take a look at the employment situation report over the last 12 to 18 months and go, come on, this is screwed up. I mean, in January, we added 3.2 million people to the population and 2.5 million jobs. And then last month, the household number, we shrank the number of jobs out there by close to 600,000. Well, whereas the establishment data said we added 150,000 jobs. I mean, everything's so screwed up with a lot of the data that even if I'm Jay Powell, I'm going, I guess it's pretty good. I'm going to say it's okay. However, I'm sure that he would like a little bit more clarity on this. I'm sure everyone on that board would sit there and love to have greater clarity on the hard data, so I can sit there and say, I am 100% confident that this is accurate, as opposed to getting sort of, I'm not going to say mealy mouth sort of positions here. Here we have it today. Hard data is one thing, soft is saying something else, blah, 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 all that stuff and doing Fed speak. I mean, I'm sure he would love to come out and say, hey, this is what's going to happen. Feel good about this data. No one can feel good about the data, and as such, they can't feel good about their forecasts. And if they don't feel good about their forecasts, how can they make any major changes to monetary policy?
Well, I think, if you listen
I'm getting a little fired up?
Yeah, you're getting very fired up.
I'm red in the face.
Almost.
No.
But, we talk about, we saw this with 2007 and some of the data that came out then, and the conversations that members of the Federal Reserve were having at that point in time, and things were, you weren't getting this pushback and this, hey, things are getting really bad right now. We're seeing these big cracks that are about to come. You're not seeing that. You didn't see it then. We didn't see it in the conversations then. We saw, Bush talking in 2007, which wasn't an economist, but he said, the outlook's great. Things are looking pretty good right now. And like 12 months later, it fell apart. And so it's proven that they can't see into the future.
No one can.
So, and they're the ones who separate. It's just as difficult. It kind of adds some validity to saying, like, hey, should we even have a Federal Reserve?
No. I mean, that's the whole deal. People have been screaming about this for years. These guys are artificially set interest rates based on perhaps faulty data and imperfect knowledge. They set the cost of money in the financial system, and it's led to bubbles ever since they've been doing it.
I do think it is smooth. It has lessened some, or the amount of recessions.
Now, what happens when you reduce risk? What do you do to return?
Oh, it's not good for it.
Well, that's right. You reduce risk, you reduce the potential for return. So if the markets were calling the shots here, I mean, who knows? Anything goes. We could be underneath a lot more risk, and if we're more risk, you have more return.
And it goes back to even the treasury markets and having trillions of dollars on your balance sheet that you're holding, and the impact that has on interest rates. Like, hey, what if we fully let the market decide? Where do you think treasuries go? Where do you think the fact that they hold mortgage-backed securities, which is crazy to me, that they're choosing which asset classes are more important?
If there was not a Federal Reserve, there is not a Federal Reserve with a $9 trillion balance sheet or whatever it is now. It's not that much any longer. I know. Seven-ish. If we did not have that type of stuff, interest rates would be significantly higher than where they are right now.
Well, I think it's hard to argue with. It's just supply and demand. If you evaporated $7 trillion of demand, and it's hard to say how much higher, because as they start to get higher, maybe other countries and firms are more.
Well, as they get that much higher, perhaps we don't borrow as much.
Sure.
And all
Look,
this,
it's all unknowns. It goes back
unknown.
to the difficulty of economic forecast. But so yeah.
So I'm sitting here taking a look at the Federal Reserve here today. No one was anticipating them doing much of anything, and they didn't do much of anything, at least in terms of the interest rates themselves. They did say they're going to slow quantitative tightening down to $5 billion a month, which is essentially chicken feed. The next stop from that is quantitative easing again. And
you have to slow down before you go the other way.
And I think that is actually probably a more realistic scenario right now over the next several months, next 3 months. Okay, into the second quarter. How about that?
Okay.
3+ months. I think it's more likely that the Fed will try to continue to tinker with quantitative easing and the balance sheet quantitative tightening, the balance sheet, tinker with that as opposed to do anything with the overnight rate.
I think that's probably fair. I think you still have people that are on the board that are comfortable letting more play out than that we've seen. Again, they're working with imperfect data, and we're not getting a super clear direction on things. I think we've talked about some of the labor market data and questions there and cracks there, but it's not like, hey, things are fully falling apart. We have to make some big moves right now. Yeah. And so with that, doing things in what I would call the background may make a little more sense than...
It might not make the same type of headlines or what have you.
Well, and doesn't impact the borrowers as directly as moving the Fed funds rate does.
So that's what I think is likely going to happen. And I would tell you that if I were the voting member of the FOMC, Federal Open Market Committee, and I'm taking a look at the data, I think inertia is just a powerful force. Because I can sit there and take a look at things and go, okay, the unemployment rate's 4.1%. Okay, the last CPI reading was a little bit better than anticipated, but we're still running 12 months at 2.8%. Doing that, that doesn't really suggest the need to cut. However, retail sales for January was horrible. Trade deficit was horrible. We're probably going to have a negative sign in front of first quarter GDP for a variety of different reasons. Sentiment gauges are falling, and then we have a lot of jobs going to be cut with DOGE and the freezing of federal workers. Because let's face it, I think federal government added some 1 million jobs over the 24 months ending in January 2025. So you take that out of the equation, all of a sudden you start taking, I don't really know what the future looks like. So I'm just not going to do a darn thing.
Well, part of the trouble to me is the timing of all this, and it's kind of similar to the timing of slowing our deficit spending. It's like, we should really be slowing this when things are going great, right? Like it's if they're starting to see some cracks, it feels like not the best time to be saying, hey, let's really clamp down on spending right now. That's when you should be saying, hey, let's put a little more money into the markets. And it's the same with quantitative easing and tightening. And like the goal should be to not have this large of a balance sheet, right? I mean, in theory, they should not be holding $7 and previously $9 trillion of assets. But then you start to see this weakness, and it feels like, this high that everyone continues to need for the markets, and frankly has felt for the better part of 15 years.
Yeah.
And stuff just goes up and to the right, and when it doesn't, we're going to figure out a way to support it and have it go back up and again. And that has led us to a point where when you start to have weakness, we haven't clawed our way back out of it the first time, just made things worse. And now is now a great time to be continuing to tamp down the balance sheet or tighten the balance sheet. And clearly they're saying no by the fact that they're slowing it down.
Well, I would tell you this, that I think you're right on a lot of things, what you're kind of touching on. Everything's got to go upwards to the right, and if it doesn't, everyone freaks out, right?
Yes.
I mean, and we used to call that the Greenspan put. Yeah. Greenspan's going to do whatever he can do in order to make sure that we go upwards and to the right.
Yeah.
And then the
pain point was very low on the pain tolerance was low.
Then we had Bernanke put. Yeah. Then we had a Powell put. Now people have been talking about a Trump put, but apparently there's not a Trump put. Everyone's anticipating some kind of put from the powers that be to keep them from experiencing any sort of uncomfort or discomfort.
In my opinion, and we've talked about this,
and the more we do that, the worse the discomfort's going to end.
But especially, I think the first half of this year, and we've talked about this added volatility in the first half of the year. This is purely my opinion. I don't think there really is much of a put right now. I think Powell is willing to let equity markets weaken. I think Trump is willing to let equity markets weaken, given his talk about the first half of the year is the Biden economy, and the second half we'll start taking credit for it. And then, you see Lutnick reiterating that. Bessent's talking about that. Bessent was saying, the Treasury Secretary was saying it's not normal for markets to only go up. Yes. So you have this consensus amongst monetary policy setters and the federal government. And so where would that put come from?
It's not going to come from anywhere.
Yeah. At least right now.
And I got to tell you, Sam, I mean, as I told our board of directors at Oakworth here today, I said it's been a really long time since we've had sort of what your textbook, your business classes would talk about as sort of a normal slowdown, where you have tighter monetary policy and tighter fiscal policy. That is what's happening right now. That's what Doge is, tighter fiscal policy. We're going to cut out some of the waste or the inefficiency in government. We're going to get rid of superfluous federal government jobs. We're going to get rid of some of the fluff. That's just tighter fiscal policy. Mm-hmm. Shrinking the budget deficit, that's tighter fiscal policy. That is what Doge is attempting to do, what Trump is attempting to do here in his first 12 to 18 months in his second term. Get rid of some of the fat, and there's plenty of fat out there, and I've people on both sides of the aisle know that.
I think there's plenty of fat even in the areas people don't want to touch.
Yeah,
the defense, there's plenty of fat.
There's plenty of it. We all know that. So we have tighter fiscal policy there. Then we have monetary policy, which I could make a pretty decent case for it before today, that, hey, we were quantitative tightening, I mean, whatever, how many billions a month it was before today? 60, something like that?
I think a little less. Than that. But
it was at one point higher.
I think they've slowly.
They slowed it 25
something.
25. Or something like that. But keeping the overnight lending target rate, we upper band at 450 when the trailing 12-month CPI, and I understand the CPI is not the Fed's preferred inflation gauge, but it's the one we all talk about. That's at 2.8%, so that's a 1.7% spread right there. No one's going to tell me that's overly accommodative. Just the real interest rates there at 1.7%. When you consider from 2008, for all intents and purposes, up until very recently, we've had negative interest rates in the economy. So when you have a confluence of these things, the economy is going to slow down. Now, where Powell is seeing this spike from inflation this go around, I think is anyone's best guess, because when I was taking a look at the last, again, CPI reading, I was a little bit more encouraged about a lot of things.
I'm still encouraged. I think a lot of this is
very much more encouraged when he's talking about inflation going to be too high for too long. Prices aren't coming down, but I mean
That's not inflation.
That's not inflation. But the rate of price increases, I don't see them going up. And those prices that will continue to go up are really due to causes that monetary policy can't fix.
Yeah.
If eggs are going up 53% in price over the last 12 months, it's not due to quantitative.
The Fed's balance
quantitative
sheet
tightening. It has nothing to do with that. It has everything to do with bird flu and having to liquidate 150 million layers. Laying hens. That's a better way of putting that, I think.
Yeah.
Laying hens over the last 12 months. The same thing with beef prices. It just really, due to the fact that from what I have read in a couple of different sources, the size of the cattle herd in the United States is as small as it's been since the 1950s.
And you also have those things that aren't impacted by these policies swing much more rapidly, and we've seen that with egg prices. They have plummeted over the last week or two, and so you're going to start seeing that in the data. And so I think how we've looked at it,
it only takes like 6 weeks to get those things laying. It doesn't take long.
I still have encouragement about the inflation data. I think pretty quickly that narrative is going to pretty much be gone. I think the tariffs are going to make things wonky still, maybe some one-time things, but at the end of the day, with some softness in the consumer and inflation already coming down, that really puts a ceiling on that. We've talked about it with consumer data and consumer CEOs, consumer product CEOs saying, hey, people are kind of tapped out. They're going to the off-brand. They're running out of money before the end of the month, so they're actually going to the smaller.
General Mills was out there over the tapes talking about the most recent earnings release. General Mills, they make cereal.
Doug McMillan from Walmart today said that they were seeing that. Saying that people were running out of money by the end of the month, and so that puts a ceiling on inflation.
Yes.
Broadly speaking, like again, food and energy. There's a reason we exclude those or use.
Well, I would tell you that, things with Walmart, things with General Mills, you still have sort of the upper end people still spending money. This past weekend, I was up in Chicago visiting Annie at the Second City. She's doing great. And at the restaurant in our hotel was the drink.
Gotta love the drink.
Gotta love the drink. Maybe. At the little... sort of cafe that they have there, Cafe on Oak, I think they call it. And hey, this is what I'm about to say is just their published stuff. I'm not saying that anything that's not accurate, not out there. Guess how much an egg was? An egg, one egg, a la carte.
$2?
No.
$4?
No.
$6?
$6.
Wow.
How about
that's a
that?
Nice markup. That's a great margin.
That right there.
Publicly traded?
Perhaps Pal's right. Maybe there are inflationary pressures. I don't know. But that was that was something else you had mentioned, the eggs, about how they'd come down in price recently.
Not at the Drake?
Not at the Drake. Not at the Drake. Oh, that's just pretty pricey stuff. So one last question for you, Sam. Here we are, Fed Day, FOMC meeting. The Fed doesn't do anything with the overnight rate, does do something with the balance sheet. Long term, how good is the Fed really at forecasting the future and forecasting the economy? And if you say really good, then how are they getting their data? And then if you say really bad, what is the purpose of the Federal Reserve?
Well, I think they're pretty bad at it, but I think the purpose of it, and I think there's some good charts that visualize this, I think they decrease how often we get these recessions and can decrease the severity of them. And the massive drawdowns, bank runs, things of this nature, I think it's helped smooth out. And again, you could point to the 30s, you could point to 2008.
But we had a Federal Reserve in the 30s.
I know, that's what I'm saying, these flaws in that. But if you look at what happened before we had a Federal Reserve and the severity of recessions and the severity of bank runs and things of that nature, I think overall there are benefits to it that have smoothed things out a little bit versus not having one. So I think it's less about, the interest rate policy, it only does so much, but its ability to help, boost the economy when things are contracting, I think helps.
Well, let me ask you this one. Now that we have gone on long, we'll just go on a little bit longer. The Fed clearly is a regulator, and then they also set monetary policy, right? So if the Fed's not good at predicting the future, or not really all that great at it by your own admission, why could I make a decent argument that the overnight rate for the Federal Reserve should be formulaic as opposed to just guesswork?
Yeah.
Where it could be the CPI, the Consumer Price Index, or the PCE price index, so we used to call it the deflator. It could be trailing 12-month plus 125 basis points.
I think
and call it a day. And that way we don't have to worry about it.
I think there'd be a lot of benefits to that. I think some drawbacks to that could be in times of crisis, kind of like the whole LIBOR thing in 2008. What LIBOR was being said the rate was versus what it would have actually been.
There was no LIBOR.
Right. And, if we set LIBOR based on what it was actually going to be, it would have made things a hell of a lot worse, in my opinion. And so that's the drawdown.
Without it, inarguably, I think.
Yeah. And so I think there's some drawdowns to it. Again, I think being able to, in times of crisis, that's where you get the benefit from the Fed, less about their direction of where they're setting policy.
I would tell you that perhaps we wouldn't have those types of crises because everyone would have a pretty good idea what the price of money was going to be.
Maybe.
All right. Well, guys, thank you all so much for listening. We always love to hear from you. Also, if you have any comments or questions, please, by all means, let us know. You can always drop us a line at tradingperspectives@oakworth.com, or you can leave us a review on the podcast outlet of your choice. As always, if you're interested in reading more, hearing more of what we got to say or how we think, you can always go to oakworth.com, OAKWORTH.com. Take a look underneath the Thought Leadership tab and find access to all kinds of exciting information, including links to previous Trading Perspectives episodes, links to our newsletter /blog, Common Sense, as well as links to our quarterly analysis and magazine, Macro and Market. And let's not forget all the good stuff that our advisory services team puts out there under Mac Frazier, as well as some good stuff that our client advisors actually sometimes provide. All right, with that being said, Sam, I'm going to let you have one last chance to talk about the Federal Reserve and just how silly they were today.
That's all I got.
That's all I've got today, too. Y'all take care.